set your ways. Looking on the city lights.
Hello and welcome to the Ken McElroy Show. I'm your host, Danille, here with Ken.
What's up? We bought e-bikes over the weekend.
We did buy e-bikes over the weekend.
You should have seen this one. Like, tooling around the parking lot.
Well, I think the best part was like Ken was like, do you want to wear a helmet? And then I was like, no, I don't need a helmet. But then the guy was showing me about the e-bike and how fast it goes. So I'm like, well, I should wear a helmet and you should wear a helmet.
No, then she got obsessive with me wearing a helmet, even though 5 minutes before. Anyway.
Yeah.
So, of course, Danille made the best choice of the bike. You know, there's so many bikes to choose from, and she picked the bike that she wanted because of the color.
Well, and it rode better. It did ride better, too. But we got bikes because we're going to be living in a van for a month this summer.
Down by the river.
Down by the river. So we, it'll be interesting. We'll keep you guys posted.
We're going to do lives from the road.
How we're doing out of our van. But that won't be till August.
That's true.
Yeah. So, but we are going to park the van in our driveway so we learn to live in it for one night.
So one of us learns to live in it one night.
And see what we need that we might forget.
Yes, right.
Because I don't know if you can Amazon to RV sites.
You guys have no idea the amount of rules that I keep hearing.
Well, there's a lot of...
Danille's very rule-based.
I order a lot off Amazon, so I probably order something off Amazon every day or two. So the thought of not having any Amazon for 5 weeks is,
It's heavenly.
It's scary. But then also, we're figuring out our food situation and our water situation.
Yes, we are.
It's very different when you're on the road. So anyways, we'll let you know how that goes. But other than that, we had a really good weekend.
Yeah.
We went to a really awesome dinner last night at Robert Kiyosaki's house with Carrie Lake.
Yeah, Carrie Lake and her husband, Jeff.
It was nice to meet them. It was interesting. So we had a good dinner. We had a good time.
Yeah. It's funny to hear the whole behind the scenes thing about when she quit and then she ran and,
and the disappointment of losing.
Yeah.
And, how she is in a lawsuit right now just to try to keep our elections safe, and keep our elections honest.
Yeah.
And I actually think that it's good she's doing that because there can't be anything bad that comes from it. You know what I mean? Like if they're not being run, efficiently, then, we should know about it. And if they are, then there's nothing to change.
Well, she didn't get into a lot of detail, but it sounded to me like she was pretty confident. So I think she's going to let it play out. We'll see what happens.
Yeah, exactly. So before we jump in today, we're going to be talking about the new rule Biden established for mortgages.
What is up with that?
Well, we're not getting there yet.
Jesus.
First, let's go into our Twitter questions of the week.
Oh my gosh.
So, Ken, you asked, landlords and property owners in 280 characters or less, tell us your worst or most outrageous tenant story.
This one's awesome.
I can't believe you asked this. But anyways, so...
just if you read the first sentence, it's enough for me.
Garrett said, my tenant's girlfriend got mad and set his stuff on fire in the bathtub. The whole building caught on fire. Got the call from the fire department. My wife was 8.5 months pregnant. She went into labor the next day. It was my first rental. Proud to say I did not give up and I still own rentals.
I don't know if you guys have ever seen that Crazy Hot Matrix, but if you haven't, Google Crazy Hot Matrix. Maybe we should put that on the credit applications.
Oh, babe. But anyway, so this is definitely pretty crazy. You just never know with couples, or people in general, I should say.
The whole building caught on fire.
I never lit your stuff on fire. I've gotten really mad at you, and maybe I've thought about it, but I've never done it.
This is the time where you don't look them in the eye. Don't look her in the eye.
Okay, let's go to the next one. Dennis said, I had 2 rentals side by side. I got called by the state police for a domestic dispute. The man that lived in one got caught sleeping with the woman from the second. The trooper and I talked them out of their altercation. Within 2 hours, they moved some possessions and swapped spouses.
Okay, first of all, are you starting to see a theme here? I'm starting to see a theme.
I mean, it's...
Nope.
I don't know what theme you're starting to see. Anyways, third.
That's called a trap.
Third one. Steve said, make sure you watch the original Hot Crazy Matrix video, guy in the white shirt and tie.
Yep.
We do highly agree. It's pretty funny. Todd says, tenant number 1 called in the middle of the night saying that tenant number 2's boyfriend was yelling and firing his pistol in the middle of the street. I told them to call 911 instead of me. Yeah, this is what you have when you have tenants, right? You have problems sometimes, and you just have to.
I don't know. I think just guy roommates. That's what I see there. Just stick with the dudes.
Oh, I don't know. I have some dude roommates that are, or not roommates, but tenants that are, they're not super simple either. Mm-hmm. Anyway, so these are pretty funny. I would love it if you guys commented with your funny tenant stories in the comments, because we'll read some of them next week.
We should do a whole book.
Oh my gosh, I have so many.
Yeah.
So many
Actually,
tenant
that's
stories.
What we should do. We should do a book because there are so many great stories like that.
I think one of my better ones is like, I had a flood in my unit, and my tenant told me that the plumber couldn't come in because he had to go to work. And how, so he called off for that because he didn't want anyone in his place without him there. So
we had a property in Texas, the lady who was on oxygen. So she had a COPD and she had oxygen, and she decided to smoke with the oxygen, and the tube shot through the roof, and then it started a fire. Luckily, no one was hurt, including her. But yeah, that's I think the latest. There's so many.
That is funny. I remember when I lived in my apartment like 10 years ago, there was this lady, and she would sit in front of her door. So she'd sit like on the walkway, and there was no ceilings or anything, and she had her oxygen tank, and she would just sit out there and smoke. So I always like took the trash out the other direction just because I didn't want to, get caught in an explosion. Anyways, smoking and oxygen tanks don't go together, for those of you that didn't know. So before we jump in today, you have a happy hour tonight with Pace Morby.
Yeah. You guys don't know who Pace Morby, you should.
Yeah, he's really, if you're into seller financing, this is your guy. If you guys don't know what seller financing is, it's where you basically assume the seller's loan, which right now could be at a very low amount.
Yep. He's got a show on TV too.
Yep.
So yeah, take a look. This is gonna be fun tonight. He's local in Arizona right now. He's coming by the studio, so he's gonna be here in person for the happy hour. And if you guys are just looking to get into real estate, that's really what he specializes in. That's why we wanted him. Is because he teaches you the subject to, that's kind of his thing. Well, one of the many things that he can do, subject to. So, I think that's a pretty good topic for a lot of people that are trying to get into real estate and don't have any money and don't know what to do.
Absolutely. And you do have to be a premium member to see this. You can just go to kenmcelroy.com, or no, I'm sorry, kensinnercircle.com. And then that is where you're going to sign up. Make sure to sign up today. It's at 5 p.m. If you miss it live, it will be on the website. And then the second thing is you do have a webinar this Thursday, and it is going to be like a preview for Limitless, because you have your Limitless conference in June. So this is just getting some people from Limitless together, George Gammon, Taro Yarber, Robert Kiyosaki, and you, to kind of break down how the dollar is losing its status and what that kind of means.
This is a big deal. I just watched a video with George, and you guys know George and I are partners in the collective, our mastermind, and of course Kiyosaki has been on the channel a bunch. You guys know him from Rich Dad, Poor Dad, but they both have very interesting views on what's going on with the currency, the dollar, bricks. It's going to be very, very, very good. They're both obviously going to be at Limitless as well in June. And by the way, I forgot, I wanted to tell everybody that the Pace, the A&E show that Pace have is called Triple Digit Flip. That's the one that he's on. So you're going to want to be there for the happy hour as well tonight.
Okay. Yep. And then so for the webinar, go back to the webinar. Jerry's going to put the link in the comments, right? Or in the show notes. Steve will. Okay. And so you guys can get signed up for that. It is free. So I encourage you to join. Okay. Can you put it in the chat as well, please?
Thanks, Jerry.
So Eric does have a funny tenant story. He said, we went to a showing, and after we walked in, we could hear the owner inside the first floor bathroom watching adult videos. We walked right back out of the house, and we didn't know what to do.
Oh my gosh.
That's funny. Well, you know what? When I was going to see one of my properties, you were with me. The tenants didn't want me to buy it because they were getting a really good deal on rent. So they were dog sitters. So they left a couple dogs and a bunch of drugs.
Bongs.
All like
Remember
bongs.
the bongs?
Yeah, like powder. All over the
What was that?
I don't know, who knows, flour maybe. But anyways, they left it all over the drawers and tables and everything, and it just looked terrible when we walked in. But
that was a good story. Danielle was like, "We're not going
I was
here."
like melting down. I was like, "We are not."
She was
buying
having a
this.
meltdown. I
This
go,
is before.
"Trust me,
This
trust
is when
me."
I used to get emotional about real estate.
Trust me. She's like, and by the way, is that deal the best deal you ever
that's
bought?
my best investment I bought. So,
Right.
but I was new and I didn't know. I was just emotional about it.
So
It didn't look very nice.
Crazy hot matrix once again.
So, anyways, so let's jump into the topic today.
This is an interesting one. I can't believe there's a lot of chatter on this online. I was at the gym this morning, and somebody recognized me, and they're like, "What are you guys going to talk about?" I go, "We're going to talk about that new rule, on penalizing people with good credit," and they just went off. Like, "Oh, I can't believe it's like it's a thing right now."
Yeah, it is a thing. And for those that don't know, because maybe not everybody knows, is the Biden administration came out with a rule, which we have to look into that because it's not a law, it's a rule. So I don't know what the difference is.
But it's effective May 1.
But it's effective May 1. I don't know if it's going to be challenged in court. I don't know if they can. We have to look into that. But basically, you're going to get basically a fee added to your monthly payment.
If you have good credit.
If you have good credit above a 740. And that will help subsidize people with bad credit because they're basically taking on more risks for these bad credit loans that they're going to be giving. And they're going to be subsidizing it off of those people and what they owe.
I know, we all the credit, there's a whole industry around credit score. There's entire industries that talk about good credit. The whole mortgage industry is based on credit. It essentially, this violates the credit risk pricing. If you think about it, the credit rating is all set up around this credit risk pricing. That's what Fannie Mae, Freddie Mac, all these groups use it. This is the exact opposite. It's actually penalizing people with good credit. I don't know about you, but this has been ingrained in me since I was a young man. I got a credit card so I could pay it off, so I could have credit. Back when I was in college, and you try to build your credit, and you try to build this credit score up. But now, basically, the Biden industry or the Biden administration is saying that if you have a 680 credit score or under, then you actually get a preferred fee structure. So essentially, they're penalizing people with good credit and rewarding those who accrue debt and don't pay their bills on time by having a little less to be able to get that same loan.
Yeah, it's definitely going to be interesting. So they're trying to make it sound like it's no big deal. Like on a $400,000 mortgage, you're looking at about $50 a month is kind of what they're saying. And that makes it sound like not a big deal. But if you think about for one, a lot of people have over $400,000 mortgages because even starter homes now are expensive. But two is that over 30 years, that's $15,000. That's a lot of money.
Yeah, and as you guys know from being in the real estate business, there was something that's called a PMI or private mortgage insurance. And what that is when you have a low loan to value, you typically PMI kicks in, and that's insurance. And what that's supposed to do is that's supposed to punish people with low credit scores and kind of even the playing field. That's the whole point of the credit score is if you have we do the same thing with rentals for apartments. You run background checks and you look at credit scores, and the people who don't pay their bills on time, that they have a lower credit score typically than those that don't, and then you can make determinations. But one of the things especially when we're renting apartments, is we need to make sure that the box stays the same for every single person. So there's no issue with age or gender or race or anything like that. It's just the exact same per person. This is very, very different, where they actually somehow decided that 680 is the number. It incentivizes. I mean, you get a better deal with poor credit.
Well, I don't know if you get a better deal. I still think that you are still paying more.
Riskier borrowers get more favorable terms, period.
Well, I just think that good borrowers are getting, lower borrowers are still getting a higher rate, but they're getting a discount off their higher rate, and good borrowers are getting a fee to their best rate. So it's not really they're getting a better deal per se, but it is rewarding. It's basically punishing good behavior.
Right. So that's what I'm saying. Like, basically, I was reading up on this. It says this is basically a middle class tax hike.
Yeah.
That's essentially what this is. And by the way, this requires a larger down payment because of the fee, and it also affects refinances.
Yeah, it affects refinances. It's gonna affect
So guys, look where we are right now. Like, real estate is actually taking it in the chin right now, right?
Well, right. It's already. So I know that our loan guy talked to Mo about it, and he's upset because it's already hard enough to get people.
My point.
To do refinances or buy a loan or want to sell their house, and this is just another barrier, because if somebody's going to sell the house that they're living in and upgrade or downgrade or whatever, now they're looking at higher rates plus an extra $50 probably. So it's just. It just is like a less of an incentive.
And if you look at March, okay, which is just a couple weeks ago, the home sales are down 22%. They're 4.4 million annualized, I think it was, versus 6 million. So they're way down, even though the inventory is down 50%. So everybody, people, it's funny. They're typically in one camp or the other. They're like, we're really undersupplied. There's not a lot of inventory, But at the same token, you can't argue with the fact that sales are down 22%, period. That you can't. That's, I think it was 1.6 million homes less. So those are the facts. And all this is going to do, if the Fed continues to raise rates next month, then and we continue to have these high inflation, this is just going to actually make things worse. I think this is a way that they're just incentivizing poor behavior. It's not a good thing to do.
Well, but it's also, you have to think of the why, right? Like, why are they doing this, right? So a couple things that I looked into is that 60% of people that buy first-time home buyers, so just first-time home buyers, have above a 740 credit score. So they're going to get a lot of extra fees if you think about it that way. And from what I've read, it's not going to help the low income borrowers anyways, because they still have to come up with a down payment. They still have to qualify. They still have to do all of those things. So basically what it was saying in the article I was reading was, this is really just a way for the banks or the government to collect more fees to try to offset these defaults that might occur.
But they're not collecting fees. They're taking good credit, people with good credit, and subsidizing those with bad.
Correct, but from what I've read is that those people with bad credit still aren't going to be able to get loans. It's not going to be like, now we're doing all these loans for people with bad credit. They still can't get the loan, and they still don't have the down payment. So it's basically just extra additional fees that are being collected to probably offset some of these bad loans that are going to come due.
What is this? I don't know.
And then the other thing that I was talking to Tom about last night at dinner, Tom Wheelwright, was that they want to have more to start diversifying some of the suburbs, So they're trying to allow people to get affordability and get in
I'm
the
all
suburbs.
for that.
But I don't.
This is not the right program.
But I don't think that it's going to do what they want. Because I honestly, the mainstream media, I was reading in there, and I was trying to find what the spin was, right? You always get what happened and then the spin. And basically I couldn't really find anybody that was happy with it. Not even in the Washington Post, the Washington Times. And what they were saying is this isn't going to do anything for people to get with bad credit to get housing. So there's really nobody that's super happy with it because there's really no positive. It's just people upset that now are going to have to pay more. And I think it's going to slow down the market even more. But like, I couldn't even, I mean, if you guys found good things, whether they're true or not on the mainstream media, because I couldn't even find anything that was really
but if you're
about it.
If you're in the real estate or mortgage lending business, this has got to be a blow to you, right? I mean, you know people are going to start making decisions because I was looking at something. This is like $50 to $100 more a month, right?
Yep.
Okay, that's a lot.
Yeah.
Especially with inflation the way it is. So, you know that could be the determination on whether or not you are going to refinance or not.
Yeah. Yeah,
or
absolutely.
even move.
Right. And Steve says,
new.
This seems to be encouraging the risky loan behavior that led to 2008. And maybe, I want to talk to our lender, Mo, about this, but I just still don't think these people can get loans. I don't think it's like that. I just think that it's basically a fee for those of us with good credit, and maybe it'll help some
What's
people
the point,
with
though?
low credit.
I mean, literally, what's the point? Because aren't we just trying to make things more affordable for people? I get that. That's fine, but to penalize people with good credit makes no sense.
Well, Wave said, does this just generate a revenue for the banks by getting it from good credit and not having to lend to the low credit people? And from what I'm seeing, yeah, that's exactly what it's doing. Unless I'm missing something or they're going to change something else on how they're going to lend to low credit individuals and make it easier for them to get a loan. But so far, they're not doing anything like that, to my knowledge.
How does this even become a rule?
Well, and that's what I'm wondering. Like, I'm wondering, it's not a law, so it didn't have to go through Congress, is what I was reading. So it's a rule, but I don't understand. Like, does the Biden administration have the power to just decide what they want to do with mortgage rules? Like, I don't know.
We got rules, executive orders, and law, right?
And this would probably just be implemented, I would imagine, on like Fannie and Freddie mortgages, government mortgages. But John says, can you imagine credit card companies operating like this? I mean, no.
Guys, everything is based on credit risk pricing. Everything. Mm-hmm. The things that you get, a car. They run your credit for everything, and this is the opposite. This is not an incentive.
Well, and somebody had mentioned on here, it really just incentivizes, the cash buyers even more, right? It helps the cash buyers, Steven says, do we know if these new fees will also affect buying rentals with your LLC, or is this just a primary residence rule? I'm pretty sure it's going to affect, because typically you're on the loan, so I think it will affect you. Yeah. I was kind of looking into that. It's so new. There's a lot of confusion still. So nobody knows 100% for sure, like, how this is all going to work.
There's a lot of angry people.
And qualify, there's a lot of angry people. Yeah. And so I do think it's going to apply to rentals. Now, it probably won't apply to multifamily, because those are different kinds of loans, but any loan that looks at your credit score, it's gonna affect.
Yeah.
And then Claudia said it's on all occupancy types. And John says, I can't wait to hear Kiyosaki's thoughts on this.
Oh, that'll be a good topic for Thursday.
Yeah. It's just one of those things, it's interesting. It's a little bit of socialism,
Yeah.
It's really taking people that have and try to support people that don't. But I don't actually hate what they're supposedly trying to do, although I think there's other reasoning. But I think that more financial education, really. I think people that have poorer credit, that grow up in rougher neighborhoods, they don't have financial education. So they don't understand how to build wealth. And I think that people that are, that have parents that, are like you in real estate or understand money, they are just going to have better credit and understand how to manage money better. Yep. And so I think that financial education is the solution. It's not trying to justify bad behavior and give incentives,
I know plenty of kids that are in college that did not grow up that way, are racking lots of debt, on credit cards, or mommy and daddy are taking care of them. So this is just promotes bad behavior. That's all.
AI said today's topic ties in with participation trophies. Everyone's a winner. Yeah, if anyone agrees, I do want to hear from you, because I was trying to I always like to look at both sides of the story, right? And I do agree we need to be helping people that are in different positions, because I think that's what makes a good society. But that being said, I was trying to find the good part of this, and I really can't find it. So if anyone likes this ruling or agrees with it, put it in the comments, because I read them and I would be interested to know, what the good part about this really is. Who is this really helping? Because to me, it seems to be helping whoever's getting that fee, whether it's the government or the bank. I don't know who's getting the fee, but that's who it seems to be helping. It doesn't seem to be helping, people with lower credit, to me.
Yeah, I know there are. The point of this is to try to help on the affordability side. I completely get that. I do. But there are people that can't afford things that have good credit.
Right.
That's the point. You don't have to have bad credit and not be able to afford something.
Well, and that's a lot of the comments I was reading and things I was reading is, people say, I'm working like 2 or 3 jobs. I got a house, and now because I'm working 2 or 3 jobs and I have a 750 credit score because I paid my bills, I'm being punished. Like, it's not just like, oh, you're being punished if you pay all cash for a house, or you're being punished if you have a bunch of money and you make, over X amount of dollars. These are hardworking people with just have good credit.
And I saw the comparison of the student loans. The people are like, it's the exact same thing where I paid off my loan and, and now they're forgiving those that didn't. A little bit different, obviously, but that's how a lot of these people feel. It's very similar.
John says that a relative of his was working with a young couple on their first home purchase, and this came up this weekend, and they're unhappy about it because it added another $50 a month, which you guys can look at it and say like, oh, $50, whatever. But you might be in a really good financial position to be able to think that way. But a lot of people are really strapped. And home prices are so high that people are really trying to get out of rentals, and they're really pushing, what they can afford. Like, I know I have a client, she's a doctor actually, but her and her husband just bought a home, and her parents are helping them with their monthly payments because they're so high, and luckily she's in a fortunate position that her parents can help. But my point is that people are really stretched. So when you just add $50, it's another $50,
Let's face it, when you're buying a car or buying a house, you're solving to the monthly payment.
Yep.
So when you add 100 to this or 50, then you actually buy less of a home. That's how that works.
Yeah.
Noah, or less of a car.
Noah says, as landlords, we should add a fee to higher credit score individuals that rent from us. No, but I think that it's interesting, right? Like it's going to affect real estate because it's just more expensive. It's just going to make the payment more expensive. I'm working on I'm putting an offer in actually on a home.
Oh,
yeah.
New information.
I know. I found it, but I'm putting in a pretty low ball offer, so the chances are slow of me getting it. But the point is it's been on the market for a year, and they want X. And it's not worth X. And now it's been sitting for a year and they're paying 2 mortgages. And I told my realtor to tell them, listen, rates are probably going to go up another 0.25% in a couple of weeks here. And you have this new fee. So if you want to take this offer, it's going to be lower next time, because that's the only way the cash flow is going to work. And so my point is like, it's going to affect prices. Like, people are just in denial about that are trying to sell too. Like, all of this is going to affect prices.
Yep. Well, like I said, we're in the second or third inning here of a 9-inning game, guys.
Dinner says, raise the rent to pay the fee, ?
Yeah.
It's another thing, like, we always want to, keep prices for the tenants affordable, but you have costs. And it has to cash flow. And it really it all kind of trickles down to either the landlord or the tenant in all of this, or the home buyer. And, it's just, It's not going to help the real estate industry, that's
Yeah.
for sure.
If a landlord can pass it through, they will.
Yep.
But if they can't, it's just going to eat into a cash flow of the landlord.
So John says, maybe this is a ploy to get home prices down even further. Maybe.
Wow. That's
Could be.
possible because that's exactly what will happen.
Yeah, that's actually a really good point, John. You're giving me credit for that, but I was just talking. I wasn't really thinking about what I was saying. But yeah, it could be a ploy because if 60% of first-time home buyers have good credit, that's going to affect 60% of people, and it's not really helping the lower end of the spectrum.
And
very
rising
much.
prices is inflationary. So
Yep.
that's something the Fed is tackling. So that's a really interesting and very good point.
Yeah, that could be one of the reasons they're doing that. Yeah, it's very interesting. So, let's jump into
All right.
our questions of the week. So if you guys want to sign up, go to kensinnercircle.com and you can ask Ken questions. We answer them on air or, just by email because you started emailing people directly now too. So for our first question, and hit the like button if you're enjoying this material. I'm a little off today. Did you notice that? I don't
Next.
know. Anyways, Chase is asking.
That's a trap, guys, as you know, right? It's just
I
a
don't
trap.
know,
It's all a
maybe.
trap.
Anyways, Chase says, "Hey Ken, do you have much luck putting ATM machines in your complexes? I've been thinking of doing this for some added revenue, but I wasn't sure if you saw much usage from your tenants."
Yeah, I've done this. So first of all, I do have friends that are in this business. It did not work for me. And by the way, we were in this gorgeous 300 unit property. We had it in the clubhouse. There's a couple things. One, ours was inside of the clubhouse so we could lock it up at night, and it still got broken into. So I remember
wow.
we had the tape and everything, but we turned it over to the Chandler police, and they're like, "Oh, there's no way. Like, these guys are wearing masks and stuff." So we did try it. We had it in there for less than a year. But one of the things I also learned is how you make money on ATMs or transactions. So call it $2, $3, each time you pull out your money. Let's say you pull out $100, it's $103. $3 goes to the person that owns the ATM. So we've never found success. And my friends that have ATMs, the most successful ones are in the highest traffic locations. So think of a casino. I had a friend that had one in a deli in New York, and they used to go in there and get some cash and then go buy something at the deli. So it has to be a lot of transactions. You don't because once you load the cassettes with the cash, you have to load those things, and you can automate and do all that stuff. That's not that hard. But the fees are where you make the money. So I would think on a property of this size, it's probably a no-go.
Yeah, I do too. I used to work in banking, and yeah, ATMs get broken into a lot. Is it your responsibility or the bank? Like, who pays the insurance on that?
I can't remember.
Yeah,
I think they actually. I don't think they actually got in. I think they broke in and they actually demolished the machine and couldn't get it open. So it was horribly
But then
damaged.
you still had to repair everything.
Yeah. I can't remember. You're taking me back too far. I erased that.
Plus, ATMs, you just don't use them that much anymore unless you're somewhere you need cash, like you said, an ATM or something. Or
Yeah,
casino
that's another
or
good point.
something.
Yep.
Okay. So Joe is asking from our inner circle, I have a successful insurance agency and I have 3 rental units of my own for investments. Do you think I should get a real estate license, or do you think I should just use a realtor? I don't have extra time to sell real estate for other people, but this would just be so I have access to the MLS, etc.
Well, first of all, I'm a big fan of having a real estate license and the education around it. So I'll give you kind of the pros and cons. So oddly enough, my son right now is going through and getting his real estate license. So he's doing this. He's not quite done in school, but he's going for the education. And so there's a tremendous amount that you can learn that way. If you do have the opportunity it sounds like you have 3 rentals, you might be able to be designated as a real estate professional based on how much time you're spending. And if you can do that, there's massive tax opportunities that you have. If you're designated a real estate professional, I'm going off of memory, but I think it's 50% of your time, which you might not be able to do because you own an insurance agency, but I don't know how much time you spend on that. Having access to the MLS, I think, is awesome. You don't have to have your license for that. You can actually, you can do that with somebody that you know. Just have them give you that access. There's the downside to at least in most of the states. I've had my license in Nevada, Washington, California, and Arizona broker. That typically a real estate license a real estate salesperson's license is hung with a broker. Typically. And so you have to have that as well. So I believe you have to hang that license underneath some kind of a broker, and there's typically some kind of a fee for that. So all those are all things to consider. But I think deal flow, being connected into a network, there's nothing wrong with that. Having the license, I can't see the downside for that, especially if you're planning on doing more of this.
Yeah, but also, if you found a really good realtor, they're probably going to be beneficial to you as well on your deals versus you trying to do it if you have a full-time job. Yeah.
It depends on how much time you're spending. Trust me, if you just connect with the right people, you'll have and tell them what you're looking for. Like, I want to look at anything over, 1 unit. So 2 units, 4 units, 5 units, whatever, 10 units, 100 units, and you just get that sent to your inbox. That might be all you need.
Exactly. So Kellen is asking, in this market, should I still be offering all cash and a quick close?
So you don't need to.
Mm-hmm.
So it's a great question, actually. I love the all cash because of the price of debt. That's the only reason. I don't necessarily think that you should need to use it anymore because I think the sellers are starting to get a little concerned. So it depends on their own personal situation, like in Danille's scenario where she's a shark, man. She's like, these two people have 2 mortgages. I'm going after them. And don't they know that these good credit fees and the rates are going up and the Fed, all this stuff that she basically talks about on this show. So not everyone comes at it from that standpoint. But I think that there's some definite benefits to be able to offer cash, like in a situation like that. Cash is going to be king. You got to determine whether or not, it's worth it, because it might not be. It depends on the loan. So I talked to a buddy the other day. He's part of our collective, actually, Scott, who has a 1031 company, and we actually had him on the show. And he said that he closed on something that was like 7.5%.
Yeah.
So pretty high. It was an investment property that he bought, but still cash flowed. So, but also underwriting is getting a little harder. They seem to be throwing more roadblocks around all that. So all cash is good, but, is it the best deal you can buy? And, what will that deal be come end of summer?
Right, exactly. Yeah, you want to do, if you're going to get a really good deal, you could try all cash. But if you're just getting an average deal, no, there's not a lot of buyers out there right now.
And I do think that the knife is falling. You don't want to catch it too early.
Exactly. So Amber is asking, how much money does a first-time homebuyer need for a down payment?
That's a tough one for me. I can't recall what the that has changed, by the way. So do you know what the number is?
I want to say it's 5.
$5,000?
5%.
Oh, 5%.
Yeah, I want to say it's about 5%. They were doing 3, but I don't think they're doing that anymore. So what I've been hearing is like 5 or 6%.
So yeah, so that's, call it $20,000 on a $300,000 house with fees and everything. And if you have good credit, it'll be even a little more.
Yeah. So. I mean, it's not nothing anymore,
Yeah. So, I think, the right way to do it is to go get qualified from, a loan officer. That's number one. Mm-hmm. You want to have all that done. and then take a look at the price point, and then you know exactly what you need. But do that first. They'll take a look at all your stuff, and hopefully you come in at 679 on your credit score, and you have less fees. But
yeah. So John from YouTube has a good question. He said, what inning, Ken, do you think this is in regards to the real estate slowdown? I ask because rates have been too low for a long time, and maybe 8 to 9% will be the norm in the next year.
That's a good question. So a couple things. I watched something the other day. I think it was Ray Dalio or maybe Sam Zell, or two guys that I watch. By the way, don't if you want to follow two people, it's Sam Zell and Ray Dalio. Two great guys. And I think it was one of them that said that they think that we're heading into a mortgage or commercial real estate problem and not necessarily a single family real estate problem. And I think that actually made a lot of sense to me. So, because I mostly dabble in the commercial real estate, we're seeing fairly big problems with transactions, low transactions, not a lot of deals being done, harder underwriting, bigger difference between the bid and the ask, and cap rates going up. And all that means that the commercial real estate is slowing down. That's commercial office, that's multifamily, that's retail, that's industrial, malls, all that kind of stuff is in that category. Of course, there's other office. Office is probably the worst because the work from home stuff. And I think Elon Musk said it the other day. He's like, the office market is toast. It's forever changed. People working from home and coming to the offices. So you have to agree with that. So what does that mean? He asked what inning we're in. So from the commercial real estate market, I think we're probably in the third to fourth inning. On a single family, I think we're still in the second. The thing about single family is that we're severely undersupplied. So that's interesting. Listings are way down, but so are prices and sales. So it's hard to know. And a lot of it's going to be predicated on what the Fed does next. So the Fed, they meet again next month. And there's a lot of people. So first of all, I just want to say this now. A lot of people are saying that rates are going to go down. The first thing that's going to happen is rates are not going to change. So in other words, they're not going to have an increase. That's the first thing. Then maybe, and only maybe, will they maybe go down at some point. I hope they do. That's what I want. But everybody's kind of predicting a quarter point, another interest rate increase next month. If that's the case, the next default would be no increase. So I think that we're going to be, if you're banking on rates going down this year, I think you might be wrong, and because of the inflation is still it's a little bit out of control. So I would say second, third inning maybe for single family, and maybe third, fourth for commercial, and I also 6-7% rates, guys. That I think that I read something that if you go back over the last 20 years, the average rate is right around 6 or 7%. So we're at the average.
Right.
You guys are all just spoiled. You guys are way below the average.
Plus, I think people think that they're going to, when they do drop rates, they're going to drop them as fast as they raised them. Like quarter point, half a point, quarter point, half a point. Oh,
That's
we're all the way back down to 4.
That's
but
not happening, guys.
It's not. Like, when they finally stop raising them, it'll probably sit for a good amount of time. And then maybe, hey, we'll drop a quarter a point a year. Or so, you know what I mean? Like, it's not going to be like it went up.
When the Fed says no rate increase, everyone will be doing thumbs up, and then there'll be a race for the next one that's going to be lower. Right? Lower rates mean inflation. Lower rates mean consumption. That's what they mean. Okay, and so they're still the inflation is still high for them, and I do think that it's going to be a little bit more painful.
So, and then MW said that. He said there's going to be a single family shortage for the rest of our lives. It's too expensive for new construction, and the number one reason is no one is willing to give up their 2% rate they locked in for 30 years.
You got it. Yep.
That is going to be a big thing. But things do happen where people do have to sell. Divorces, transfers for work, things like. Not everyone wants to be a landlord, or they try landlording and they do it wrong and it blows up in their face, or those kind of things. So
That's why the subject
they'll
to model is going to be
slowly
so
come
good.
up. Yeah, subject to will be really
Subject
good.
to, guys, don't miss that happy hour tonight.
Yeah.
Let me tell you what that means. If you got a 2 or 3% rate, you're not going to want to give that up. That's an asset. On a subject to, somebody can come in and you can make money on that rate. Right? You can have them pay a little bit more, and you keep that same loan. So there's lots of really cool, creative ways to do this. But I agree, most people aren't going to just forgive that. They're not going to move out of a 2 or 3% debt into a 6 or a 7.
Right. And Sherelle has a good comment. They said the Fed needs higher. The Fed needs higher rates to be able to have some ammunition in case the economic trouble. They're not going to give that ammunition quickly or easily if they don't have to.
Right.
Because they do. They need, if we do go into a recession, they need to be able to lower rates to get us out of it potentially.
So that's the problem they had before. One of the interesting things I was watching one of George Gammon's videos this weekend. As you guys know, we're doing a happy hour with George and Kiyosaki on Thursday for Limitless. And that is in the show notes as well. But in that, I thought it was really interesting. He was showing the federal funds increases, and then he showed when they flattened off. And after that, that's when the recession hit. So the recession never hit while rates were being increased. They hit when they stopped. And he went back over 4 different recessions going back into, I think it was into the 80s. So just take a look at that. There's a lag effect with this. So anyway, so I think a lot of people believe that there's still a pending recession coming.
Yep. So Joseph is asking, he said, I am assuming a good portion of the commercial deals made in the last 5 to 7 years are going to be facing maturity default with the balloons coming soon. With the economic reset underway, what commercial asset class do you think investors should look at, and which ones do you think investors should walk from?
So it's a good question. Well, you got to look at future demand first. So from a demand standpoint, it certainly looks like multifamily is going to be a good one, not just because I'm in it, but because of the renter nation. As single family gets priced, as the mortgage payments are further away from the rents, then it forces more people into rentals. And if somebody's cashing out of a home, and they decide they don't want to pay that higher interest rate, they might just sit into rentals and wait. And I also agree that because of the price of homes today and the fact that there's not a lot of new ones being built, that we're going to have some supply issues. So I think multifamily is strong. I think retail and office are in trouble. So those are two that I would be careful of. And as the loans mature in those two assets, then you're going to start to see more and more of that stuff. Industrial seems to be really, really good. So that what they call last mile distribution, which is, you guys all got super spoiled with Amazon, being able to have something that afternoon. Well, you have to have it close to you. So, so that is all housed in in what they call last mile distribution. So industrial, I think, is going to be really, really, really strong as another asset class. So those would be the ones. I'd be careful of office and retail, because retail, obviously, the bricks and mortar, you go into, we went and bought these e-bikes this weekend, but because we wanted to go look at them, ride them and all that kind of stuff. But a lot of times those days are gone. You can order that stuff, come straight to your house, you assemble it, and you're good to go. You don't really need bricks and mortar like the old days. So those are the two areas I'd be careful. Be careful office.
Yeah, and retail. Also, during everything that happened, the big retail anchors were kind of holding hostage the landlords.
Yeah, that's true too. Yeah. I think ironically, one of the categories that's supposed to do really, really, really well are supermarkets, food. So that, in a retail center, if you have a anchored by, let's say, one of the big, larger supermarket, you're probably going to be fine. But, look what's happened to Sears is gone, Macy's is gone, Kmart's gone. You start to look at, I guess, trinkets. What's that, Jerry? Bed Bath & Beyond filed this week, Chapter 11. Yeah, some of that real estate's going to be hitting the market. Also, banks. I don't know how many times, how many of you guys have walked into your bank lately? Like, seriously. I mean, I get it. I get a check. You could take a photo of it, and boom, it's in that. It's deposited. So, banking's changed. A lot of things have changed. So, those are, by the way, some of the best corners in the world are where banks are. So, keep your eye on that. So, I think it's change of use, redevelopment.
Yeah, a couple of people on here, a few people they're saying, they don't know how much higher rates are going to go because it's going to break the banking system or because people won't be able to buy things. But the other thing you have to consider is the inflation. So inflation, it affects certain people, we notice it, but some people, it really affects where they can't, pay their bills. And inflation really is that's what will start real problems if people can't keep up at all.
Yeah, food and shelter. I think,
and electric.
But don't forget, guys, they're trying to have people not buy things.
Yeah,
that is the point of increasing rates. So, houses, cars, TVs, anything that's financed. That's the point of higher credit card fees. All that kind of stuff affects purchasing negatively, which is helpful for inflation. Because that's what they're trying to do, actually, is they're trying to tamper down that consumer behavior and slow things down. Yeah,
absolutely. So Joseph is, Joseph. We have a lot of Joes and Josephs on here right now. He is saying he was reading the article out of Yield Pro and saw that improving fundamentals for senior housing in Q1, that the demand for senior housing has increased for independent living, assisted living, and nursing care. However, the cap rates for these asset classes are up, some by 50 basis points from last year.
Yep.
What are your thoughts behind this?
Yep, he's right. I have a very good friend I met with last week. He's got a very big assisted care company, and he's right. So, again, this is a math thing. So I think, how long ago, Jerry, was it that baby boomers started retiring? Like 10 years ago, 7, 8, 9. So just look, I can't remember. So baby boomers, when they turned 55, right? Is it 55? Yeah. There was like 50,000 a day retiring. I think that was the number. So that's math. So think about that. If you just take a look at people's age and how quickly they're retiring or aging out, I guess, and trying to figure out what they want to do next. That is there's a certain phase. First, there's active living, which I own 4 or 5 of those. Then the next one is assisted care, and then there's congregate care. So there's different levels of how somebody moves through the system. And that's all going to be math-based, based on when people were born. And, of course, you got to subtract the deaths and all that kind of stuff, which is not a great thing to talk about, but it's a fact. If you can actually take a look at the generations are all tracked back to when the year that they were born. So all of that is pushing demand on these senior care facilities. And it has been that way for some time. My senior properties they're full as can be with waiting lists and they're active seniors, so we don't offer a lot of extra services. But it's a really, really, really good sector for you guys to look into. I will tell you, just from caution, that the industry that my friend Steve's in, once you start getting into medical care and food service and all those kinds of things, it's a whole different level. So that's why we've chosen to stay in the active senior realm, which is basically like we have a property in Sun City, Arizona. You have to be 55 in order to move in there, period. And then they stay there as long as they can until they can't. And then they move to the next level. So that's generally how that works. But I do think that we're going to see some real strength in that area.
Yeah.
It's expensive too, though, by the way.
Well, and how do people normally, they sell their house and then they kind of roll it into that monthly payment, basically?
Well, you know what we did with my mom is we kept her house and rented it.
Well, that's a smarter thing to do.
Yeah. So my mom's house, where I actually grew up, everyone in the family wanted to sell it, and I was like, no, capital gains and step up in basis and all this stuff. So if you don't know what that is, just Google it. But basically, I was looking at the tax and the net and all that kind of stuff, and how much money that we could. As my mom was getting to the point where she needed, we wanted actually some other people around to watch her, and so we ended up renting her house, and we have it almost right down to the number. So my mom's happy because she still has her house, and she still, that's a big thing to her, is that she still owns her home. But two, it's her asset that's actually paying for her living, which is also good for her. So, my sister does all the heavy lifting for me because it's up in Seattle. And, we have a renter in her home that basically pays the rent. But those rents can be, 3, 4, 5, 6, even more per month, depending on where they are. So these are not inexpensive facilities.
Got it. So Lance wants to know, when will prices equal out to new interest rates? Everyone wants to know that.
So what do you mean here?
Well, when will the prices really haven't fallen as much as the rates have gone up?
I don't know. I wish I knew. I can tell you already on the commercial side, we're seeing a minimum of 20% price adjustments. So we're not really seeing that on the single families.
Right.
So a $50 million deal is $10 million less. It's 40, right? So as a buyer, I'm offering 40. A year ago, I would offer 50. Oddly enough, isn't that interesting? That's because the interest rates went from 3 to 6. So that's the difference. So same property, same tenants, same rent, same expenses, same ownership, same everything. What's different is the mortgage payment. So from a cash flow standpoint, you have to offer less. So you offer less. And so we've seen at least a 20% discount on commercial. I don't know about single family. I think it's going to depend largely on where where people are going and why. There are markets that are still actually pretty strong, like Florida, North Carolina, some areas of Texas, even some parts of Arizona. Even though Phoenix is down a little bit, I think there are other areas that are up.
Right.
So, it's just going to depend. There's a slower leak in the balloon for single family than there happens to be in commercial.
Yep. And commercial, a lot of that is on people that were in hard money, or they are in loans that are expiring.
Perhaps, yes.
Yeah. Awesome. Well, make sure you guys check out the happy hour tonight. Go to kensinnercircle.com to get signed up. Pace can help you learn all about seller finance.
Yeah, this is good stuff, guys. Like if this is a great time for this topic, and this is why we wanted Pace on the show. Think about that. If you're sitting on a 2 or 3% asset loan, and lots of equity, this is the show for you.
Well, and if you want to sell your home and you really want to get the most you can for it, and you have a loan that's 3%, you can look at selling your home with seller financing as well.
That's my point.
So
that's good.
Yeah. So anyways, make sure you guys check it out. We'll see you next Monday.
All right, guys. See ya.